Welcome back to House. Thank you for viewing us. So today I think it'll be reasonable, I suppose, to start talking about the different asset classes out there.
Good idea.
Okay, and so I'll just go straight into it.
Yep.
So the most risk-free, if you like, so I've got the risk curve. Risk means you got a chance to lose, effectively. Okay, so the most basic asset class out there, the safest asset class out there, is cash at bank. Okay, so in Australia, for example, we are guaranteed, capital guaranteed to $250,000 deposited in a cash account, bank account.
So, Ellie, is it what you're saying is if you have $300,000 and the bank goes under, you'll get 250, but you'll lose 50?
Correct.
Okay.
In those terms.
Right. And is that the rest of the world?
No, it's Australia. We put it in place during the GFC.
Okay, so
a long time ago.
So was that why overseas, Greece, America, etc., people were so worried about their savings because they could lose it, and that's it?
Correct. So, and that's something called a run on the bank, where potentially a lot of people are going to withdraw their cash at any one time, at the same time, and one bank in particular, and then that bank fails.
Wow.
That has happened.
Okay.
In America recently.
Okay. Yep.
So that's cash. Going further up, you've got cash equivalents like fixed interest, term deposits, terms that you may understand. So, for example, you have a question on term deposits?
So your normal fixed interest rate here in Australia, it's basically 5%,
Yep.
Give or take.
Yeah, every.
And then if you fix your funds, let's say for 12 months,
Yep.
they may pay you 6%.
Correct. So, duration, the longer you fix it, potentially the higher the return may be.
Okay. Yep.
That makes sense. You can have a 3-month term deposit, 6 months, 12 months, 24 months, however long.
Okay. But if something happens, can I pull my money out?
You can pull your money out, but there will be a cost. There's a break fee.
Right.
So it's penalised for breaking. Let's say it's a 12-month and after 6 months you want your money back.
Yes.
You will be penalised.
Okay. Yep. For sure.
All right.
Yep.
So it'll cost you. Then the next kind of asset class I would deem would be property. So,
yes.
So, and Ben, you know property better than I. There's all different assets within property, but as a cluster, I'd say property.
Well, property's normally very safe.
Correct.
It's pretty much a AAA rated asset class because most people pay their mortgage.
Most people, correct.
Yeah, most. So in Australia, for example, you'll have a mortgage. You can have a mortgage with a bank, and if you cannot make the payments, then what will happen is the bank can seize the property, okay, after many notices that you'll receive. That will destroy your credit rating, and then what they will do is they will end up selling the asset, and if you owe a lot more money than what is actually that the asset sells for, then that causes other issues as well. They can chase you for the money, or you can go into bankruptcy, and you just don't want to be in that position.
Correct. And then the next asset, so high risk asset to property, will be stock market. I know it's a big topic. People always talk about, shares, this and the other. But in Australia, the ASX, Australian Securities Exchange, for example, buying equity in a business, listed business like BHP, like Rio Tinto, like Telstra. And then it'll be international equities, buying on the US stock exchange, on the NASDAQ, on the Japanese stock exchange, whatever it may be, anywhere overseas. Again, high level of risk. You've got exchange rate issues, Australian dollar issues as well to think about. So for example, buying Apple stock, buying Microsoft, and then I would deem the highest risk asset would be venture capital. And that's something that I've got a bit of experience with, and that's buying it very early into a business. So before they're listed. So someone's got an idea, built a proof of concept, built a business, it's generating a bit of revenue, maybe not profitable at this stage, for example. You are buying a stake in that business. You're providing funds for them to grow their business. That is a very high level of risk. Not so popular in Australia, but overseas it's very, very popular to get access to. And then the most, if you like, risky would be, I would say, punting, using that word, into the crypto market. And it's something that Ben's got a bit more experience than I do, but we've engaged in that practice.
Yeah, the crypto market, as we've all seen, it's had its ups and downs. It was basically where the sub $500, basically, 2017, roughly? And then it really started to gain momentum. Now, I think we're sitting at just over 40K.
American.
Yeah, a coin for 45K. It's pretty crazy. And there are thousands of different coins. And you're really, it's gambling at its best. With crypto, there's no question about it. You'd only get into crypto if you can afford to lose your money.
Absolutely. It's unregulated, so by definition, it's quite risky. And so from all those assets, as I mentioned, the higher we went up, so we started for cash, we ended up at crypto, the more you should demand, so it's called the risk return profile, the more you should demand in terms of return. There is no point investing in crypto when you may get, for example, 5% return, because you can get 5% return today in any cash at bank. So for instance, if you want to go make it simpler, invest in the share market, you should be looking to have a return higher than 5%. It's called the risk margin. Call it, you want a 10% per annum return. Otherwise, keep the money in cash. That's the risk return profile. The higher you go at the risk, the higher the return should be, in theory.
That makes sense.
Yep. And by definition of risk, as Ben said at the beginning, you can lose everything. Cash at bank, there's a cap. You can only lose up until 250,000. In reality, it's never happened in Australia. For Bitcoin unknown, it won't happen.
Yeah, so it's normally, so how to look at your money is basically, if you want a safe return, that means you have a lower margin. Okay? If you want a crazy return, that's when you've got to take a lot of risk. And that's when you need to think to yourself, can I afford to lose it? If I lose this money, will I be homeless? Will I be able to eat for the next week? And this is what happens. It's real world.
Yep. And in another podcast, we're going to talk about diversification, because obviously you're not going to put all your eggs in that one basket. For example, let's say you've got $100, make it very simple, you're not going to put $100 in international equity or into crypto. Obviously not. You're going to spread it around.
Yep. I think that sounds good, Ali. So that gives the viewers a bit of an idea about different levels of risk and what opportunities are available.
Absolutely. And in future podcasts, we're going to go in a bit more depth in each of those asset classes. So that was just a very quick summary.
Yep, I agree.
Perfect.
Excellent. Love it. We'll see you next time. Any questions, please leave a comment and we'll get back to you.
Excellent. Thanks.